Good morning, everybody, and welcome to our spring budget analysis. My name's Phil Hartley, and I welcome you all to the webinar today. A bit of housekeeping before we get started. If you can't hear me at the moment, then you can log on to the audio via your telephone. Number and access code are on screen now. I'm going to apologise in advance if there's any technology issues. We should be dab hands at this by now, given this is the third one in the last 6 months. But please do accept my apologies if there are any. For those that don't know me, I'm one of the tax directors here at Mitchell Charlesworth, specifically focused more around the corporate tax side of things. Have knowledge of the other taxes as well, but I day-to-day, about 70% of my workload is related to corporation tax, particularly structures and acquisitions, mergers and R&D and capital allowances, and all things corporate tax, really. Please ask questions throughout the webinar via the chat function that we've got here. I'll answer as many of them as I possibly can at the end of the webinar. If there's ones that I don't get to or ones that require a bit more detailed of a response, I'll come back to you directly after the webinar. And you can contact me directly after the webinar if you'd like as well. My email address is on screen now. Don't worry, it will be on the screen at the end of the webinar as well. The session is being recorded, and the recording will be circulated along with the slides following the webinar. So no need to try and make a detailed notes in this. You'll get these as well afterwards. So what we're going to talk about today. I'm going to start off with a bit of a recap on where we are or where we were heading into the budget and the previous announcements we've got and where we were looking into before Jeremy Hunt made his announcement on Wednesday. I'm then going to move into just a bit of a refresher on the income tax changes that are coming up from the 5th of April, 6th of April even, and how that can impact us as individuals moving forward. Big area of the webinar today is going to focus around corporation tax and what the rate rise means initially, and then moving on to, well, how can we combat that rate rise, and in particular looking at the R&D tax relief and the capital allowances sections that were particularly mentioned in the budget on Wednesday. The other big element of the budget was the changes to pension tax relief. And I'll go through what they mean and how they ultimately will work and benefit individuals with high pension balances in the future. Bit of an overview of other matters that have been announced, and then answer any questions that you may have at the end of the session. So, a bit of a recap. What did we know was coming in from April 2023? So we knew that the additional rate threshold for income tax, so this is where for individuals that were earning over £150,000, and the additional rate is 45% for income tax and then 39.35% for dividends. That was reducing that threshold, so we were going from 150,000 to 125,140 pounds. That's a very specific number because between 100 and 125,140 pounds is where we start to lose our personal allowance. So as soon as we move from losing our personal allowance and paying an effective super tax rate of up to 60% on income, we then move straight into the additional rate tax band. So and more tax for higher earners as a result there. We knew about the dividend allowance, and that would be reducing from the current level of £2,000 to £1,000 from April 2023, and reducing further to £500 from April 2024. We also knew about the reduction in annual exemption for capital gains tax, so that was reducing from £12,300 to £6,000 in April 2023, and then again to £3,000 in April 2024. We knew that the idea of corporation tax increasing to 25% had been put out there and was being legislated for from the current rate of 19%. And we knew that the super deduction was ending. The super deduction brought in from the 1st of April 2021 for a 2-year period, and that was to cease on the 31st of March 2023. We also knew that R&D tax relief rates were changing, So the additional expenditure under the SME scheme was dropping down to 86p from £1.30. The credit rate was reducing to 10%, but the RDEC rate was increasing to 20% from its current rate of 13%. So just a bit of an overview on the income tax and national insurance changes, because in the last 6 months, we've had many announcements and reversals and changes. So just a quick overview here, just to demonstrate where we are heading into April and the new tax year. So obviously, under the Liz Truss and Kwasi Kwarteng's regime, they were going to abolish the 45% rate initially. Obviously, that had a significant effect on the markets. And Jeremy Hunt came in and reversed that abolishment and actually went one step further and reduced that threshold down to £125,140 from £150,000. So a big switch in the last 6 months and a big change in approach from government to government. We were going to have a drop in the rate of income tax as well. Income tax was going to drop by 1% to 19%. Again, that was abolished by Jeremy Hunt straight after the market meltdowns that we had at the end of September, beginning of October. So basic rate of income tax remaining at 20% for now. Dividend tax rates are also remaining at the same level. Bit of controversy there because the dividend tax rates went up as a result of the health and social care levy that has ultimately been dropped as well. And so the additional 1.25% on the rates showing is the health and social care levy as was. And that hasn't been removed from dividend tax rates and won't be removed from dividend tax rates. So they will be remaining at 8.75%, 33.75%, and 39.35% respectively. As I just mentioned before, dividend allowance, we knew, and it's continuing to be the case, will reduce to £1,000 from April 2023, and then £500 from April 2024. And what was known as a stealth tax, ultimately, is that the personal allowance and the national insurance thresholds are going to remain the same until 2028. I think that's also probably going to be the case for the basic rate band threshold as well. That will ultimately stay the same as well for that period of time. And I can't envisage the additional rate moving again. I think that will stay the same as well. So what does all that information ultimately mean for our back pockets, which is the main thing? So actually, with a table on screen now for salaries, purely for salaries at this point in time, shows what was the net income on different levels of salary in the 22-23 tax year, the current tax year. And what does that mean then moving into 23-24? And as we can see, for up to £125,000 earners, it's an increase in income. And that's because of the dropping of the health and social care levy. The health and social care levy was dropped in November of 2022. So we had a half a year with it and half a year without it. We're now moving into a full year without it. So income gradually, as earnings increase, the net income is increasing as well. But then you can see that there's a big drop off. There's a drop off there, a big drop off in net income position at 150,000 and 200,000, and that's because of the reduction in the additional rate threshold. And ultimately, that's the only reason for that reduction there. So that reduces the net income for those higher earners. They're not receiving as much as they would have done without that reduction in threshold. This example's for small salary dividends, so classic remuneration approach for shareholders, director shareholders of companies. Again, same scenario. What is the net income in the current tax year? What are we moving to? Ultimately, every band will see a reduction in their income in this particular period, and that is because of the reduction in the dividend allowance up to £125,000 per annum income. That 88 is 87.5, and it's because of the 87.5 at £1,000 reduction in dividend allowance. And the bigger reduction at 150,000 and 200,000, again, because of the additional rate threshold being reduced. So although less income, I think if I just go back, you'll see that actually still the net income figures are much higher than under a salary. So salary dividend approach still provides a much higher net income based on the differing levels. So the big area, or one of the big areas of the budget, and corporation tax. And there was a lot of speculation heading into the budget that because of the healthier forecast than anticipated, and because there was a bit of wriggle room for the government to operate within as the higher tax receipts being received, that they might actually reverse this rise in corporation tax to 25% that was introduced in November 2022. And actually, it didn't. It confirmed that increase would be implemented at this stage and at this moment in time. So we're moving back to a system that we had when I first started out in tax, of differing rates for depending on what your profits are in a particular year. So profits below £50,000, they'll be taxed at 19% moving forward, which is the current rate of corporation tax. If your profits are between 50,000 and 250,000, then they are taxed at something called the marginal rate of tax. It's an effective rate rising as profits go higher. And the next slide will show you how that ultimately works and what rate that is applicable. Important to point out that it's not a case of your first 50,000 being taxed at 19% and then moving into a higher rate. It's an all or nothing scenario rather than a progressive rate change as we have with income tax, for example. If your profits are over 250,000, then you'll suffer the 25% corporation tax rate. Now, the Chancellor believes that's restricted to 10% of companies in the UK. From our client base, I think that's probably a bit higher, but we'll wait and see. There's also some changes in determining how many companies are associated. So at the minute we have it that you're an only associated company if you're within a group. So it's called the 51% group rule. So you're only connected in that respect if you're in a group, and that currently only impacts on if you have to pay quarterly installments. It reduces that threshold down in determining if installment payments are required or not. We're moving to a system where it's associated companies. So an association can mean various different things. It could be like husband owns company, wife owns company, or brothers and brothers, or companies that, say myself as an example, I have 3 companies, let's say, each of them I own individually. Well, they would all be classed as being associated and therefore connected with corporation tax. And that impacts on the thresholds that we've just talked about here. So for example, let's say I own 2 companies personally, and I take the thresholds that we've just mentioned above and divide them by 2. So actually, if my profits are under 25,000 in any one of those companies, I pay 19%. Between 25,000 and 125,000, it's the marginal rate of tax. And anything over 125,000 would be 25%. So potentially having more companies and owning more companies will reduce these bands and impact on how much corporation tax would be due in the future. So I just mentioned there before that the marginal rate of tax and the between 50,000 and 250,000 for a sole company. Well, what is the rate of tax that ultimately I would pay? So 50,000, as we say, that's 19%. But as we then start to go over, the effective rate of corporation tax increases. So at 60,000, it's 20.25%. 75,000, it's 21.5%. Moving its way progressively up to when you get to £250,000, you will be paying a corporation tax rate of 25%. So it's not a case of you go over 50 straight into 25%. It will progressively increase forward. For companies that we act for, we will calculate what that position is. The software will determine that position accordingly. So no need for you to worry how you would calculate that. You can leave that one with ourselves. So with that increase in mind, what can businesses do to really reduce, companies in particular, to reduce that corporation tax burden in the future? And what a lot of companies have looked at in the past is R&D tax relief. It's been a very popular tax relief for many years now, as it progressively got more and more beneficial to make claims. But what we have seen from HMRC, and HMRC have openly discussed this, is that they identified this time last year widespread abuse of the R&D tax relief scheme. We're talking millions and millions, if not billions of pounds of what they perceive as being abuse in the scheme. And that was particularly surrounding the SME scheme. They don't feel that it is within the RDEC scheme. but particularly in the SME scheme, they felt that there is widespread abuse there. And we have seen, and many advisors on this matter will have also seen, that R&D inquiries are going up, very general in nature in some instances, but they are looking at them in more detail than they have done in the past. We've also had lots of government consultations and government research documents, and they seem to indicate that actually the RDEC scheme provides more value for money and more reinvestment in R&D activities than the SME scheme does. And we also have a consultation ongoing, which wasn't, and no announcement surrounding that in the budget, which I thought there possibly would have been, but we have a consultation that's been ongoing about shifting R&D tax relief in just to one regime. So not having a regime for SMEs and a regime for large companies, ultimately having one regime to cover both that is more based on the RDEC scheme rather than the SME scheme. And that will be quite important and to understand what that position could be in the future as well. So we knew coming in to the budget that there were changes coming into effect from the 1st of April 2023. The SME enhanced deduction for qualifying costs, that was previously 130%, and that's reducing to 86%. So instead of getting, for example, if we have a £10,000 spend, instead of getting an extra £13,000 qualifying deduction, we've actually got an extra £8,600 now. The SME cash credit rate, so this is where if a company undertaking R&D activities is making a loss and is surrendering those losses to HMRC for a cash payment, that rate is reducing to 14.5%, from 14.5%, sorry, to 10%. And the RDEC rate, which is the basis for determining how much credit a company does receive, that's actually increasing. So that backs up what they believe their research to be. Actually, the RDEC rate, which is generating us more reinvestment into R&D activities from companies, we're going to increase that rate because that's how we feel the RDEC rate, the RDEC regime works better than the SME scheme. And that rate's increasing from 13% to 20%. So just some examples. Let's put some figures on this and let's show you how it works ultimately. So we're going to use the example of £100,000 qualifying expenditure on R&D activities. This is the same level of figure throughout all the examples I'm going to show you now. And I'm assuming that the corporation tax rate is 25%. So the actual spend on R&D, because that goes through the profit and loss account, and that would attract 25% of corporation tax relief pre-R&D claim. So if you did nothing, no further activity, you're going to get a 25%, 25 grand corporation tax relief on that spend. The SME scheme, the SME R&D scheme, that provides an additional £86,000 of qualifying expenditure, and that goes through the tax computation in reducing the profits for the year. And ultimately, at 25%, provides an additional £21,500 in corporation tax relief. So the total corporation tax relief, being the relief on the actual costs plus the relief on the additional expenditure, is £46,500. Now, under the old regime of 130% and a corporation tax rate of 19%, the actual rate of an actual amount that you would receive under the R&D would have been £44,700. So it's actually an increase of £2,800 in this example in comparison to the current rates. Where it does impact quite heavily is on a loss-making SME. So this could be a startup or become a loss-making for tax purposes as a result of their R&D claim. So again, using the same example, we're going to exchange the lower of the total R&D spend for tax purposes, which is £186,000, and that is your initial spend, your actual spend, plus the additional deduction that's provided from HMRC. And it's the difference between that and the taxable loss for a cash credit 10% of the value. I'm just going to assume for this purpose that the low figure is the £186,000, and that provides a payable cash credit of £18,600. So the amount of received back over the initial £100,000 spend provides a benefit of 18.6p, or maximum benefit of 18.6p for every £1 that is spent on R&D. In comparison, the current rate provides a maximum benefit of 33.75p p for every £1 spent on R&D. So it's a significant reduction in benefit of 14.75p for every £1 spent. But I'm going to caveat that at this stage. This is now for just non-R&D intensive companies, and I'll move on to what that definition is shortly. The RDEC example. So official RDEC rate is going to be 20% from the 1st of April 2023. However, the RDEC credit in itself is subject to corporation tax, and that, assuming that's at 25%, the net benefit of that claim is actually 15p, as the RDEC credit itself is subject to corporation tax. So again, £100,000 on R&D activities generates a £20,000 credit, but that is subject to corporation tax at 25%. So that reduces that credit down and resulting in a cash repayment of £15,000. It'll either be a cash repayment or it can be offset against other tax liabilities. There's a bit of a step-by-step process with RDEC, which is probably a bit too complicated to go through in this webinar. But ultimately, it's either we can offset against corporation tax, or if there's other taxes outstanding, we offset against that to calculate a position where there's a net amount at the end that could be repaid as cash to the business. Under the current rules, the 13% being subject to corporation tax provides a net benefit of 10.53p rather than 15p. So actually, under this example, the additional relief as a result of the increase in the RDEC rate is an extra £4,470 in this example. So a much higher rate of relief for businesses moving forward. We've also got some significant operational changes that are coming to R&D world as well. And this is in line really with the fact that they feel there is a lot of fraudulent activities, claims that have not been backed up potentially with suitable qualifying activities and qualifying reports or information that HMRC needs to be able to make that determination. So these operational changes include an additional form. So in the minute, for example, with the claims we do, we submit supporting evidence to HMRC via an R&D report. Our report, in our opinion, covers a lot of what they need, but they're now providing a specific form that they want to receive as the supporting evidence for the R&D claim. That's only going to come in from the 1st of August 2023. That's a slight delay from when they initially wanted that. They're going to introduce that from 1st of April, but the form mustn't be quite ready yet. So they've now moved that back to the 1st of August 2023. If a company hasn't made an R&D claim within the last 3 years, there'll then become the need to notify HMRC that they're going to make a claim within 6 months of the end of the accounting period it relates to. So if we took, for example, a 30th of June 2023 year end, and the company makes a determination that actually they've undertaken some R&D activities in that year that qualify for the relief, they would have to notify HMRC before the 31st of December 2023 that they're going to make a claim. So that's a new way of looking at a new barrier of entry almost into the R&D tax relief scheme that needs to be considered as well. Each claim will need to be endorsed by named senior officer of the company. Effectively, they will need to sign the claim off and say that they are happy with the details that are being included. And agents like ourselves, we will also need to include our details on the claim to advise them that we have advised yourselves on the R&D claim as well. So this is all measures trying to ultimately reduce what they perceive to be a bit of a fraudulent marketplace that's occurring, and potentially advising on matters that ultimately shouldn't be advising in the first place. Important point to note that there was meant to be a restriction coming in from April 2023 on overseas expenditure. Ultimately, what they were hoping to achieve was that only expenditure incurred in the UK would qualify for R&D tax relief. So salaries of employees in the UK, contractors in the UK, etc., etc. That's actually been delayed by a year to April 2024. And the thinking behind that is what we were discussing before, the fact that there may be that they're looking to change to one system rather than having two separate systems. They've decided that actually, well, we'll delay this restriction until we've determined what we're moving to, and then we'll consider that in in the context of the new system. So for companies that utilize contractors in Eastern Europe, mainland Europe, or anywhere in the world now, that restriction that I've spoken to a few of my clients on, that was coming in from April 2023, bit of good news, it's only coming in from April 2024 at the moment. So a bit more time to plan and prepare and decide how to move forward on that basis. I mentioned before with the cash credit, the budget provided was with a new type of company almost, and a new type of definition known as an R&D intensive company. And this is under the SME scheme in particular. So there was a bit of negative feedback, obviously, to the government, the fact that the cash credit rate was reducing from 14.5% to 10%, and effectively it was 14.75p reduction for every £1 spent on R&D on what a company could get back. And it was particularly hitting hard your startups. Ultimately, startups are spending significant money on developing something new, rely upon the R&D regime to a certain extent to help fund that, along with other ways of funding, and they were going to get hit hard as a result of these changes. But what the new rules seem to indicate is that actually, if you're classed as an R&D intensive company, you will revert back to the current rate of cash credit of 14.5%. rather than the 10% cash credit rate. So to be classed as an R&D intensive company, you need to be loss making, you need to be an SME, and you need to have the R&D expenditure needs to represent at least 40% of the total expenditure incurred by the company in any particular accounting period. As I said just before, it will revert back to 14.5% cash credit rather than the 10%. And actually, that means the maximum relief of 33.35p for every £1 spent would be available from the cash credit. At this stage, we've not got legislation to determine how that will ultimately work. And what HMRC have said is that legislation is not going to be coming until probably around summertime. So initially, companies like this would have to claim under the 10% rate, and then would then have to make a further claim to up the amount if they qualify under the new definition. Devil's in the detail here. We'll need to see the legislation to make sure this is exactly how it is. But for companies that may be affected by this, we'll be on top of it. Please do ask any questions, and we'll be providing more information out once the legislation has been released. Another big area here in terms of what was announced in the budget, and that's surrounding capital allowances and investment by businesses and companies in particular. And we got a new relief as a result of this budget. So everybody was aware that the super deduction was ending on the 31st of March 2023. And there was a lot of talk and speculation of, well, actually, could you not extend the super deduction? What are you going to do instead of the super deduction? Because this is something that's helped drive investment, and something that, with the increase in corporation tax rate coming in, something that is needed like this to allow companies to plan and invest in the future, and ultimately not reducing that corporation tax liability down, so to allow that investment to occur. So the super deduction was providing up to 130% deduction against profits on new and unused qualifying assets, and I say that's ending on the 31st of March 2023. From the 1st of April 2023, we are getting a new allowance known as the full expensing, and I'm using commas there because it's not quite full, and I'll explain why. But this new system is coming in from the 31st of March 2026 until the 31st of March 2026 even. And this will ultimately is going to provide 100% deduction against profits on plant and machinery main rate items. Now, the guidance has been announced, provided surrounding this doesn't make reference to new and unused as it did with the super deduction. So I'm taking that at this moment in time to mean that could be any item that's classed as plant and machinery, new or second hand, would qualify for the 100% deduction. And we've got the deduction that, and that's main rate items, apologies, and the deduction falls to 50% for items that fall into the special rate pool. So this tends to be items that are covered under integral features, so it could be electrical items, water treatments, etc., etc. So it's not quite full. When they've used the word full expensing, well, it's not quite, because of certain items and certain assets that could be purchased that don't receive a full deduction. So what's the impact here? What does this ultimately mean for businesses? Full expensing will provide a corporation tax relief of up to 25p for every £1 spent on main rate items, and it's up to 25p because of the differing levels of corporation tax potentially due ultimately, and potentially subject to on the companies. Under the super deduction, the relief was up to 24.7p for every £1 spent. So actually, businesses don't need to suddenly go, I need to benefit from the super deduction. I need to get something in before the end of this month because I get the super deduction. Because actually, broadly, the relief is the same now with this full expensing system. Important to note, there's no upper limit on the full expensing system, either, like with the super deduction. So again, no real need to accelerate the purchases because of super deduction ending here. It can be more planned out with the benefit of the full expensing system for main rate items. As we said before, the special rate items, the full expensing doesn't provide full relief. Ultimately, it only provides 50% relief. But we have still got the annual investment allowance, which has been around for many, many years and is remaining at £1 million. And legislation has been brought in to permanently keep it at that £1 million for a 12-month accounting period. And that does provide 100% deduction against profits up to a spend of £1 million. And that includes special rate items. And so therefore, you're going to be in a position where actually you're claiming AIA annual investment allowance before full expensing on special rate items to maximize corporation tax relief. Again, if you're one of our clients on the webinar today, we will deal with that position and maximize that tax relief position for you. Just some other corporation tax announcements that probably have been not really picked up upon and things that we all need to be aware of, really. First one being that patent box tax relief, quite an important tax relief for companies that have patented items and are generating profits from those items. And it was confirmed in the budget that actually the effective tax rate on those profits from a patent of 10% is remaining at 10%. And that becomes even more important now with a 25% corporation tax rate, because effectively it's a 60% reduction in corporation tax rate that we're talking about there. So something to be thinking about for anybody on the webinar today that have patents on items and products. Are you claiming patent box? What can we be doing to have a look at that position? And please contact me if you want to talk about that in more detail. In previous budgets, we've had extension to the rates of relief for theatre, orchestra, and museum tax reliefs. And they were meant to end or start to taper down even from the 1st of April 2023 and reverting back to their previous levels, original levels in April 2024. And the businesses like this and charities like this in particular will be pleased to know that we've got a 2-year extension as a result of the budget. So actually the relief is will start to taper down from the 1st of April 2025 and returning to normal levels from the 1st of April 2026. And in tandem with that announcement, museum tax relief, which was set to expire in March 2024, that's been extended to March 2026 as well. And just on electric vehicle, a quick point on electric vehicles here, extension to the 100% first year allowance for electrical vehicle charging points. So that was meant to end on the 31st of March 2023. That's now been extended to 31st of March 2025. And 100% first year allowances are still available on new electric vehicles as well. The other big element in the budget was the pension changes, and ultimately what the very much reducing of the restrictions surrounding pensions and pension contributions, which ultimately is very much a U-turn from a lot of the speculation that we receive before any budget or any fiscal statement on pension tax relief, because it's such a costly relief that is provided. Many budgets and many people always say, well, that's the easy one to target. Ultimately, reduce that, you'll get some money back into the coffers. But we've got a shift in mentality from this government at the moment, and that actually what they're seeing is that a lot of high earners and successful individuals are retiring early. Between your 50s and between 50 and 65, the retirement rate has increased significantly. And one classic example is doctors in the NHS. They're maxing out their pensions to the point that when they're then contributing more, they're triggering a potentially a big charge in the future. and it doesn't make it financially worthwhile to continue to work. So, and this is as a result of the lifetime allowance. So pension lifetime allowance, you can ultimately put into your pension at the moment a maximum level of £1,073,100. And if you invest over that allowance, it could be taxed as high as a rate of 55% on withdrawal from the pension scheme. Significant tax rate there. And we've also got an individual can invest up to £40,000 into their pension pot per year, and that is known as the annual allowance. And if you invest more than £40,000, again, you could be taxed at your marginal rate of income tax. So that could be as much as 45% on the amounts that have been put into your pension over and above the annual allowance. But what the budget did changed all this. So from the 6th of April 2023, the lifetime allowance and the lifetime allowance charge, being that 55% rate, they've been scrapped. So that completely now removes the restriction on how much an individual can invest into their pension pot. There was talk that they might increase the lifetime allowance to 1.8 million, but no, they've completely scrapped it. So it is no longer a thing to be concerned about for people investing into pensions. And also from April 2023, the annual allowance will be increased to 60 grand per year. So that's increasing the amount that can be invested per year into your pension pot as well. That obviously comes with a lot of income tax benefits, but also going back to corporation tax, an effective way for director shareholders to extract money from the business is for the company to pay a pension contribution on their behalf. And that was restricted each year to £40,000 per director shareholder. In this instance, now you can put in a bit more if cash flow permits. So you're going to get, let's say, with 60 grand at 25%. That's a significant corporation tax saving as a result of these changes. Just some other notable announcements that were made in the budget. Energy price guarantee, so households, that's been extended to until June 2023 at the same £2,500 level. On average, the government anticipates that a saving of £160 per household. Notably, though, there was no announcement of extensions to support for businesses. So the business equivalent to the energy price guarantee ends on the 31st of March 2023. So that really is an important point to be aware of. Childcare, for me, I was hoping this would come in sooner with my family dynamic, but the extension so that all children between 9 months and 4 years old will get 30 hours free term time childcare. That will be fully implemented by September 2025. But the actual mechanics of starting that only start from April 2024. So from now until then, still under the same rules that only 3 and 4 year olds get the 33 hours. And it gradually comes into place so that by September 2025, all children between 9 months and 4 years will get 30 hours free term time childcare. We had a bit more information on investment zones, and in particular, we're getting an investment zone in Greater Manchester and in Liverpool as well. And that will ultimately provide a package of tax reliefs for businesses that are located and move into those investment zones, including stamp duty, land tax relief, further enhanced capital allowances for plant and machinery, enhanced structures and buildings allowances, which is a capital allowances on buildings ultimately, and some class 1 national insurance contribution relief as well for eligible employees earning up to £25,000 per annum. And then just generally more economic announcements there. They anticipate inflation to start to significantly reduce. They feel that we're going to avoid a recession in the UK, and that gas prices are anticipated to fall significantly as well. So positive outlook there being perceived from the budget. But my summary here is that this budget was aimed at retaining and attracting and enticing back to enhance the workforce that we've got in the UK. But for businesses, I felt personally that it was a bad budget for businesses, in my opinion. You've got the higher corporation tax rate, you've got the reduced R&D benefit, and you've got the support on energy prices ceasing. I feel more was needed to support businesses through this next 6 to 12 month period, where it could could be quite difficult for businesses. But with an election potentially due in May 2024, so only just over a year now, what I feel the government is doing is saying, well, let's get to that point, and this time next year, ultimately, let's roll out a whole load of tax cutting measures. So that, I feel that will involve an income tax cut. So we may go back down to the basic rate, going down to 19%, and more giveaways to businesses if the economy recovers as is anticipated. So that's all from me in terms of the webinar. But let me go through some questions that we had. And we received a question actually yesterday via email on the pension changes. And what that question was is that when the pension lifetime allowance changed in previous years, there wasn't the ability to protect the allowance at the previous level. And the question here was, will the changes that we just discussed on the lifetime allowance affect anybody who applied for protection of their earlier lifetime allowances ultimately? And unfortunately, I'm going to have to sit slightly on the fence here and say the devil will be in the detail. And we will find that out when the legislation is released. What I can say is that the guidance notes does make reference to the fact that people were given that opportunity to protect their lifetime allowances. So my view would be that I think it will apply to all. Personally, I don't think it will just apply to anybody who didn't protect their earlier lifetime allowance. I think that would be a bit unfair, in fairness, on people who did protect their lifetime allowance, because you've done it with that legislation in mind at that period in time, and the legislation has ultimately changed. But we will find out more detail when that legislation is introduced. Just another question here. We're a trade protection association governed by Constitution, entered into by all our self-employed barristers. Do we now become governed by the association rule for corporation tax? Good question, and I'd probably have to understand a little bit more about that business there, if you don't mind, and come back to you. My gut feeling is you probably don't have control over those self-employed barristers, and therefore you're not going to be classed as associated. But I'm happy to have a bit more of a look at that and come back to you with a bit more detail. If you'd email me a bit more detail with my email address on screen, I'd be more than happy to have a look at that then. Just a couple of questions on R&D tax relief. Is a reduction in the SME enhancement percentage from 130% to 86% retrospective, or effective only on R&D spend from April 2023? Only effective from spend from April 2023. So claims in the future will need to be, if you've got a period, let's for example say we've got a 31st of December 2023 year end, you're effectively going to have two periods of accounts that need to be determined for R&D. You're going to have the period from the 1st of Jan to the 31st of March that's governed under the current rules as we stand, and then the period from the 1st of April to the 31st of December 23 under the new rules. So we'll need to make sure expenditure is split between those two periods to ensure we're claiming the correct level of relief. But no, it's only effective from 1st of April 2023 spend. And can a construction company take advantage of R&D tax relief, e.g. ground investigation, architect, design costs, sites, etc.? I feel the answer there is yes. Obviously, it depends very much specifically on what has been undertaken and how you've gone about it. But we've done claims for construction companies in the past that have gone through HMRC and we've not had inquiries on. So it's definitely worth having a look and seeing if what you are doing is qualifying activity. And I'm more than happy to have a no obligation initial chat with you to go through in a bit more detail what your qualifying activity is and what activities you're undertaking, and help you make that determination to then move forward to the next step. I think there's just one more question coming through, so we'll just keep it going. But the other one of the questions I've had internally actually quite a lot, which is just to make sure everybody is aware, is I have the question: what is the difference between full expensing and annual investment allowance? And it's a valid question, because it does, on the face of it, looks like, well, under both you're getting the same treatment. But as we just discussed in the webinar then, yeah, full expensing is only full on plant and machinery items that go into the main pool. So that can include IT equipment, it can include vans, it includes machinery, etc., etc. Whereas if under the full expensing route, items that go to a special rate pool don't fully qualify for full expensing. They only qualify for 50%. So you then fall back on the annual investment allowance to get that 100% relief up to £1 million spend in any accounting period, in any 12-month accounting period. So just again, that's a bit of planning, a bit of thinking it through, and a bit of what we will do to ensure that we maximise the tax position for our clients. But there is a slight difference, and it's important to know what that slight difference is rather than just thinking, well, they're both the same, it doesn't really matter. One last question that's come through. Is the associated company rule a straight 50% split if you have two companies, or can you elect one to use the full allowance? Is unused allowance in second company lost if profit level not reached? Unfortunately, it's just a straight split. So it's not a case you can elect to go, right, that company's going to get the full allowance and that company's not. What it's doing is going, right, because you've got two connected companies, what we'll do is the thresholds will reduce. And that isn't really to stop trying to divert profits around so that one company is not paying a certain level that it should be paying because you've just done charges between the two companies. So no, it's just a straight split. You can't elect to switch one to the other. So it's just a straight split of like I showed in the example there. Happy to go through that in a bit more detail with you should you want to have a bit more of a conversation surrounding that. So yeah, that's it from me. Thank you very much, everybody, for attending the webinar today. I hope you found it useful. As I said, email address is on screen. You're going to get the slides. You're going to get a recording of the presentation. But please do come back to me if you have any questions. And I look forward to speaking to you, hopefully in 6 months' time, rather than what we have been doing previously, when we have the spring statement, October, November time. Thanks again, and speak to you soon.